Hi, this is Michael Kolb, CFP from Evergreen Wealth Solutions here with your January 2024 update. It's actually a rather good start to the new year for markets. It's up 1.7% for January, the Dow was up 1.3%, and the tech-heavy NASDAQ was up just slightly over 1%, lagging its other peers a little bit. But this was the third consecutive month with positive returns for each of the indices. And this was also supported by great earning fundamentals. 37%, about a third of the companies reporting, and earnings growth was almost 4%, which was well above the 1.2% increase that was expected. And this was broadly spread across all different types of sectors, with 9 of 11 sectors reporting higher earnings. In addition, all three major industry indices finished January above their 200-day moving average, which is a great indicator of technical strength. Internationally, the EFA gained about 0.5%, while the EM market was actually down 4.3% on a sell-off in Chinese stocks, which we will talk about later. When it comes to bonds, it was a rather volatile month for bonds. There's a lot of interest rate volatility that occurred in bonds, and the aggregate bond index ended up losing about 0.25%. So what was going on in the economy? Well, there was a lot to be really happy about from an economic standpoint. GDP growth came in stronger than expected. The job growth came in healthier than expected. Unemployment stayed down at 3.8. Consumer spending grew. Retail sales, personal spending growth all went through the roof. And also consumer sentiment, how they feel about the market, actually went higher as well. So there is things to be concerned about from an economic perspective, and most importantly, I think it's inflation and rates. But inflation came in just slightly higher than what was expected for the year. But most importantly, that we can talk about is the Fed. There's a lot of news around the Fed, which is what caused that bond volatility. We ended the month with an update from the Federal Reserve saying they were going to keep interest rates unchanged, which was expected. However, it wasn't expected to hear that they don't expect to have a rate cut in their January or in their March meeting. That's a big disconnect between the market expectations and what the Fed is saying. The market was expecting somewhere around 6 rate cuts for the year starting in March, and the Fed saying it's probably going to be more like 3, and it's not going to start till May or maybe later than that. So we need to make sure that we're monitoring what those risks might be here in the US. And the Fed and inflation is by far the biggest risk that we see in the market here. We also have political risks that could come around with an election year, as everybody knows. We have rising tensions in the Middle East. We have the conflict in Ukraine. We have a slowdown that's continuing to happen in China that could have negative impacts from a global perspective. But all in all, we had a really solid foundation for the new year. The economic and market fundamentals are both very sound, solid economic growth, better than expected earnings growth, supporting the market as we head into this new year. Inflation and the Fed are the biggest things that we want to make sure that we're monitoring, but we think they're closer to the end than they are the beginning. And importantly, equity markets actually tend to rally in the 6 months following a rate cut. So it could be a really good sign for the second half of the year as well if we do end up getting a rate cut. But there's always the potential for short-term setbacks. So make sure that you have the type of portfolio you feel comfortable with the volatility that it has. And make sure that you also are talking to your advisor if you don't feel that way so you can sleep well at night. Thank you and have a great day.